Naveen Kulkarni is here to discuss markets and investing with us. Naveen, afternoon. Naveen, first of all, what's the hypothesis for the market right now as we sit? How are you analyzing the data points? Can we reverse our underperformance versus the world over the next, say, the near term to medium term?
So, reversing the underperformance will take more time. Right now, because the what has happened over the last 1 year is that interest rates globally have gone up, right? So that has resulted in the foreign debt being reasonably more attractive than what it was probably a couple of years back, right? So money, of course, is shifting towards foreign debt and probably even foreign equities where valuations are more reasonable than Indian equities. So this is an adjustment process which will take time. Once the adjustment process is through, probably 3 months down the line, then I think the underperformance will start reversing and it might start reversing in a more meaningful manner. Right now, I think we are in that zone where we will be in a sideways kind of a market. And probably if global markets were to go up, we might underperform a little bit.
Case building, risk reward turning attractive. The next 18 months would be much better than the last 18 months.
Surely, see, one good factor about the equity markets right now is that valuations have become quite reasonable, right? That's very, very clear. Second factor is, let's say that if I were to look at number of stocks which are trading to, let's say they're closer to their 52-week highs, will just be around 20-22 stocks which are trading close to their 52-week highs. Third factor, which is more of a technical indicator, is that if I were to look at, let's say, the number of stocks which are trading below their 200-day DMA, or let's say number of stocks which are trading about their 200-day DMA, is just around 37%, right? Or maybe right now it would have come down to around 33-34%, which over long term tends to be in the range of around 53-54%. Clearly, that is also an indicator that market is in an oversold zone, right? All these factors point out towards one clear aspect that market is in an oversold zone. Valuations have become attractive. So more likely the returns over the next 18 months are going to be much, much better than the last 18 months where valuations were quite high. They're trading at 2 standard deviations above mean, right? Stocks were trading at record levels in terms of their 52-week high lows, in terms of their number of stocks trading about their 200-day DMA. All these factors were actually not very, very conducive for making returns in equity markets. Right now, the factors are very, very conducive for long-term investors to buy and hold for, let's say, a year, and I think surely returns will follow.
Interesting. Naveen, what are your thoughts on the broader market, the mid cap and the small cap end of the market? Do you see more value emerging there?
Clearly, so mid caps and small caps are, let's say, an area which is very, very interesting. So if I were to go back, let's say 7-8 years back, mid caps and small caps used to be not really sizable in their overall business operations. Right now, if I were to look at, let's say, the largest mid cap or a largest small cap in India, would be close to about $1.5 billion, right? Which is a sizable company, right? So from that perspective, businesses have become much more stable than what they were probably 10 years back because of the compounding growth that we have seen. And of course, it's not a big secret that mid caps, given a sufficient amount of time, and small caps where there is quality, will deliver good returns. So with the correction that we have seen in the equity markets, right, mid caps and small caps have become attractive. But only thing that we have to bear in mind is that we have to focus on quality, right? Because this is a market where we can buy quality without paying a premium, right? So that's the idea that we have to look at. So if we are looking at mid caps and small caps where there is quality and there is not much of valuation challenge, I think those are like very, very good areas to make money over the next 12 to 18 months.
Right. Let's talk some of the specific areas. In private sector banks, one view is that this quarter we could see some NIM pressure. We could see some slowdown in the kind of growth we are talking about, credit growth, because credit growth overall has come down. The other thing is that if this does provide a correction. People should get back in. What are your thoughts? Private sector, large private sector banks.
The private sector banks, of course, are in a very, very strong position right now. Right? So there is absolutely no uh, doubt that private sector banks' balance sheet is in very, very strong quality. In the last 10 years, we are at a decadal high in terms of the balance sheet quality. Right. So that is the bigger essentially challenge which banks face. Right. It's the quality of the balance sheet and the return ratios. Right. If those are strong, credit growth can be managed. Credit growth will be lower one quarter, may not be very strong in 1 month, but it can always come back, right? Because India is definitely capital starved country. We are at a inflection point where the capacity utilization across sectors has gone up. You look at power sector, we see that the capacity utilization is going up. This summer might be very, very hot. We'll see further improvement in capacity utilization. So all these factors put together, credit growth might be slower in 1 quarter, but it will pick up over the next couple of years for sure, right? There is absolutely no doubt on that. The challenge, of course, for banks will be the short-term challenges. What will be the name and how they manage their ratios. But overall, I would say that banks are in a very, very strong position. Valuations have also become reasonable. Growth is, of course, very, very consistent, and quality is very, very strong, right? So most of the private sector banks are delivering a good double-digit ROE, and that's the kind of returns that you can easily expect over the next 2 to 3 years. So any correction, I feel that private sector banks are very, very good. I would say that opportunities to look at in this kind of a market.
Now, when you look at Reliance quite closely, the stock has corrected very nicely from 2850 odd levels to almost 2200. Uh, does it provide good risk reward right now, looking at the valuations and also some of the concerns on balance sheet and growth?
Yes, so I think risk reward in Reliance has definitely become attractive. So let's say that when the stock was in the range of around 24, 2500, I used to see that probably the upside is not very, very high from current levels, but I see that the fair value for Reliance should be in the range of around 2600 odd, right? So considering that, let's say the retail business is valued at close to 800, 900 rupees, then there is Jio, and then there is, of course, the petchem business, which is the O2C business, which is doing quite well in the current scenario, considering the GRMs are holding up. So my overall opinion right now on Reliance is that currently Reliance to me looks undervalued at these levels. Of course, it's a fairly large enterprise, and there is obviously supply of the stock. But if I were to look at it as a long-term holder, this is a reasonably good level to enter Reliance, and where I would say that the stock delivering a return of 15% over the next 12 months seems extremely likely to me.
What are your thoughts on, if I compare the underperformance of HDFC Bank versus the market, there was a good 2 year underperformance and then it started reversing 1300 to 1650 almost. Kotak Bank has also gone through its own share of derating. Do you think at 1700 odd, Kotak Bank prices in most of the issues, or you think it's ripe and again risk reward over there?
Yes, so if you look at let's say the top tier private banks, which is let's say Kotak uh, and HDFC, right? So these are the two banks which are underperformed over the last 2 years, and the basic reason for that is that they had a significant valuation premium with regards to let's say ICICI Bank or a Axis Bank or a SBI, right? So there was a significant valuation premium that these banks enjoyed. On the other hand, the other banks essentially started seeing a catch up because of the balance sheet quality started improving, available at a reasonable valuations. All those factors actually played out in favor of the other banks, and they actually outperformed the likes of Kotak and HDFC Bank. Now, I believe that there is a certain degree of parity which has come in with regards to, let's say, a HDFC versus an ICICI versus a Kotak, right? So that I think has started to come in. Second, of course, is that Kotak and HDFC are typically defensive stocks, right? So people will typically gravitate towards a Kotak and an HDFC bank whenever there are challenging times. And I see that these current times are challenging for the equity markets. From that perspective, there is a very high likelihood chance that we will see that people will gravitate towards Kotak and HDFC, considering that there is a de-rating which has happened. We are not paying a significant amount of premium for the quality that these two banks offer. All these things put together, I think Kotak and HDFC Bank have a reasonably good chance that they might outperform the banking sector over the next 12 months.
Last question, Naveen. I see that you also have some of the large, cable companies as your top picks. Polycab, for particular. Polycab and KEI, both cable companies, were at 52-week high even before this small correction is playing out right now. Versus the market, major outperformance. Do you think that this is a temporary phase they are going through? How's the business model looking, and can they continue doing well in coming quarters as well?
See, if I were to look at, let's say, the whole cable industry, so think of it like this, right? So there is a significant amount of capacity creation which is happening across the board, right? So from that perspective, the cable companies are directly on that. That's point number one. Second point is that more important thing that you look at these companies is that how efficient the business models are, right? So if I were to look at Polycab or a KEI, right, these companies are fairly efficient in terms of their business model. Add to that, valuations are not very expensive. I would say that these are companies which can still deliver good returns, let's say over the next 6 to 12 months, and these are like decent companies where the market size is not very, market capitalization is not very small, liquidity is decent, institutional participation is not very bad, right? So all those factors put together, I believe that these companies can still deliver good returns.
Right. All right, Naveen, thanks so much for your time this afternoon. Before we take a break, also hear out what Lawrence Belanco of CLSA view in the market is.